Hello and welcome to the special segment called MC Pro Select Stock of the Day. In this segment, we bring to you fundamentally strong stock ideas that you can consider in your portfolio. So today's stock of the day is SBI. SBI, if we talk about the company, then it is the largest bank in India in terms of the assets, deposits and operating profit. Balance sheet size of over 66 lakh crore as of March 2025. Government of India owns 56.92% of the bank's equity capital. The bank has one of the largest branch networks in the world. Though its non-banking subsidiaries and joint ventures, it offers a wide range of financial services such as investment banking, credit cards, life insurance, general insurance, fund management, primary dealership, broking and factoring to look for. Now, what do we like about the bank, you may ask? Strong business growth. SBI's overall advances grew by 12% year-on-year at the end of March 2025 on a huge balance sheet, which is impressive. In fact, the growth in the retail loans that constitutes 42% of SBI's loan book slowed to 11% year-on-year after RBI tightened the regulations for the unsecured lending. Within the retail, the express credit, which is unsecured loans, saw no growth in financial year 2025, while the gold loans grew the fastest at 53% year-on-year. The growth in the corporate loan book, which constitutes 34% of the bank's domestic loan book, was muted at 9% year-on-year, mainly due to large prepayments. Now, the bank's deposit growth of 9% year-on-year as of March end lacked advances growth as well as the banking system growth. Despite the slower deposit growth, the SBI is relatively best placed with credit to deposit ratio of 69.7% on its domestic book as at the end of March, significantly lower than the banking industry CD ratio. Now, the management is comfortable up till CD ratio of 75%, indicating a headroom to grow credit portfolio at a healthy rate. Now, SBI's asset quality stands best in over a decade with gross and net non-performing asset ratio, that is your GNPA and NNPA, trending downwards and slippage ratio remains very low. Now, GNPA and NNPA stood at 1.8% and 0.5% respectively at the March 2025 end. Consequently, the credit cost still is very low compared to the historical average and management does not see it rising significantly even in the unsecured credit. Moreover, the higher provision coverage ratio, that is your PCR, will cushion the further earnings. Let's talk about the healthy return ratios. SBI's margin at 3.22% in financial year 2025 is on a lower side compared to the private peers. With potential cuts in the policy rates further, the margin will be under pressure. In fact, the management aims to maintain the margin above 3%. Operating expenses declined due to the normalizing of wage expenses and helped in offsetting the muted margins. Cost to income improved to 52% in financial year 2025 and management sees ratio in the range of 50 to 52% in the medium term. In fact, they delivered return on assets of 1.1%, which is very healthy. Capital raising plans. SBI's Tier 1 capital ratio improved in financial year 2025 as the bank's ROE remained higher than its credit growth, leading to the capital accretion. Now, however, SBI has taken enabling board resolution to raise 25,000 crore of equity capital in financial year 2026, depending on the business needs and the market conditions. Now, capital raising at the current price will be book value dilutive for the shareholders as the bank is currently trading below the value book. The stake sale in the Yes Bank will support in near to medium term. But what will drive the earnings growth in the coming year? The management is guiding credit growth of 12 to 13% in financial year 2026. Now, SBI has a pipeline of 3.4 lakh crore on corporate side, of which 1.7 lakh crore is sanctioned but not dispersed. Moreover, the express credit segment is likely to see pickup in financial year 2026. Margin will come under pressure. Now, cost to income ratio also improved and it will gradually increase due to cost rigidities. With credit costs already at lower level, there is no scope for further improvement. The biggest cushion to ROA in financial year 2026 can be from treasury gains as bond yields can further soften due to the rate cuts. With that, it's a wrap. For more such updates, keep watching moneycontrol.com and please like, share and subscribe to Moneycontrol's YouTube channel.